afternoon and good morning wherever you are. On behalf of my colleagues, I would like to welcome you to this timely webinar on banking systems and risk of climate change. Our program will start with opening remarks by Stefano Latembe, the Director of Financial Management Department. And after that, the panelists will make a 10-minute presentation, then we will open the floor for questions. So without further ado, I would like to welcome Stefano Latembe to offer his opening remarks. Stefan?
Thank you, Mohammed, and good afternoon, colleagues. Good afternoon, distinguished speakers, ladies and gentlemen. It gives me great pleasure to welcome you all to this FDB Making Finance Work for Africa seminar on banking systems and the risks of climate change. I'd like to extend a special welcome to our distinguished panel members, Monsieur Morgan Després, Deputy Head of the Financial Stability Department at the Banque de France and Head of the Network for the Greening of the Financial Sector Secretariat, Madame Najwa Mouhaouri, Head of the Green Finance Unit Bank Al-Maghrib, Morocco, and my colleague, Dr. Anthony Nyong, Director of Climate Change and Green Growth Department at the bank. Ladies and gentlemen, Africa is the most vulnerable continent to climate change. 7 out of 10 of the countries most vulnerable to climate change in the world are located on our continent, despite Africa having contributed the least to global warming and having the lowest emissions. The impact of climate change on the environment, human life, and economies is undeniable. Allow me to illustrate what I'm saying with just a few points. By 2100, rising sea levels could cost the world $14 trillion a year. Climate vulnerability has cost developing countries already 62 billion in higher interest rate payments across the private and public sectors. Additional interest payments attributable to climate vulnerability are expected to increase to close to 130 billion over the next decade, further exacerbating the financial indebtedness of developing countries and threatening future investments. Finally, climate-related financial risks could affect the economy through elevated credit spreads, greater precautionary saving, and in an extreme case, lead again to a new financial crisis. Climate change is a real long-term investment risk for investors. For the banking system, physical risks may materialize directly through the exposure to firms, households, and countries experiencing climate shocks, or indirectly through the effects of climate change on the economy as a whole and its impact on the financial sector in particular. Corporate credit portfolios are also at risk. Transition risks may materialize on the asset side of banking institutions, which could suffer losses due to their exposure to companies whose business models are not based on the economic principles of reducing carbon emissions. The financial sector and the banking sector in particular should play a key role in mobilizing resources for investment in climate change mitigation in order to reduce greenhouse gas emissions, as well as in climate change adaptation through building resilience. Africa's commitments under the Paris Agreement represent a 3 trillion investment opportunity by 2030. 75% of the investment is expected to come from the private sector to complement the public sector financing. This calls for innovative approaches to attract and steer financial flows towards low carbon and climate resilient development solutions. Ladies and gentlemen, the urgency to address climate changes in Africa warrants global support, but Africa's private sector and financial institutions in particular also have a key role to play. That is why our discussions today will focus not only on the risks of climate change for the African banking sector, but also on the opportunities it represents and how best to take advantage of these opportunities. We'll also hear about facilities available to support the financial sector as it adapts to the reality of climate change. I'd like to again thank our expert panel for agreeing to share their expertise with us today and all participants for taking the time to join us. I look forward to an insightful discussion and now hand back to Mohammed to steer us through. Thank you very much.
Thank you very much, Stefan, for those wise words. Colleagues and ladies and gentlemen, we all know that climate change is already affecting nearly every facet of our economy, including infrastructure, agriculture, and others, including human health and labor. If urgent corrective actions are not taken to mitigate and reduce the risk of climate change, it will impair and impact our productive capacity of our economy and will undermine its ability to generate employment, income and other opportunity. And that is why it warrants our full attention and the attention of every government, enterprise, and individuals. Against this short backdrop, our objective today is to share with you some of the thinkings on, one, the role of different actors in the climate change inherent or associated risks, global initiative to green banking, challenges and opportunities, coordination and dialogue among stakeholders, and the way forward. So without further ado, let me introduce our panel of experts and specialists in this field. Let me start with Mr. Morgan Dupree. He's the Deputy Head of Financial Stability Department at the Banque de France, and also serves as the head of a network of central banks and supervision for greening the financial system secretariat. He joined Banque de France in 2005 and served in the Payment and Settlement Systems Department, and also as a deputy of Macroprudential Division. Other professional experience of Mr. Dupree includes secondment to the head of financial stability within the Treasury Department. Also, let me introduce Najwa Moheri. She is the head of the Green Finance Unit within the Banking Supervision at the Bank of Al-Maghrib. She has more than 5 years of experience within the Supervision Department at the Central Bank. And prior to joining the Bank Al-Maghrib, she held positions of financial analyst and investment analyst in the field of investment banking. Najwa holds a master's of financial analysis from Nouméa Business, France. Last, certainly, but not the least, let me introduce Dr. Anthony Nyon. He's the Director of Climate Change and Green Growth at the African Development Bank. Tony has about 30 years experience in environmental and natural resource management, renewable energy, and green growth. He has held various positions at the African Development Bank prior to his current position. He was, in fact, the head of renewable energy, head of gender and climate change sustainable unit, and head of compliance and safeguards division. Before joining the bank, he was a senior climate specialist at the International Development Research Center of Canada. Tony also serves on several global scientific boards, including Sustainable Stock Exchange and Green Finance Advisory Groups. So with that, let me give the floor to Mr. Morgan Dupree to make the presentation. The way we're going to make the presentation, we'll have a maximum of 10 minutes. We'll give maximum of 10 minutes to every panelist to make a presentation. We will have the 3 presentations, and then we will open the floor for questions. Mr. Dupree, thank you. You have the floor.
Thank you. Thanks a lot for having me. It's really a privilege to speak today. I will try to be brief but clear by presenting in a nutshell the role of the central banks and supervisors network for greening the financial system. And I will try to bring a bit of an African focus, because I understand this is what we are interested in more specifically today. Could we please move to next slide, please? So let's begin with who we are. The network is actually a strange animal. It's not an international organization. It doesn't have any legal existence. It's actually a club. Initially, it was a club. Now it's quite a big club now, but it's really a club of central banks and supervisors who decided at some point in time in December 2017 at the One Planet Summit to team up and do things together. It's not more than this. Why? Well, simply because we had the feeling, we sensed that things were a bit difficult at the level of the G20 for political reasons, and we felt we central banks and supervisors needed a place to share our knowledge, our questions, to learn more and make progress together, because it's a complicated issue, and we had really very little clues as to what to do, and we thought we had to talk together. And because we couldn't find the right fora to do that, then we set up our own club, and this is it actually. When we started, we were 8. Now we are over 75 members. I would say today, as we speak, more like 80 members and 13 observers. So it has grown significantly. And we have also quite a number of African representatives. Initially, one of the pioneers was the Banque Al-Maghrib, who joined us at the very beginning of the network. And Banque Al-Maghrib is a member of the steering committee of the NGFS. But progressively, we got more African central banks who joined us. For example, the Central Bank of the West African countries, the South African Reserve Bank, Mauritius Central Bank, Seychelles, and recently Central Bank of Tunisia. And recently as well, we had the financial regulation authorities from Egypt who joined us. So progressively, we are getting more and more representative, and it's a very good thing, because we really want to reflect all the concerns and all the perspectives from the members. Could we please move to the next slide? So the first thing we did within the network was to frame the question, because honestly, 3 years ago, finding a real rationale for central banks to do something about climate change was a little bit of a challenge. And a lot of people were telling us, but come on, you're central banks. Why on earth do you want to do something about that? It's not your job. It's the job of governments to do things, not yours. And after, having done some research internally, we came to the conclusion that climate change was a source of structural change, of course, in the economy and also the financial system, and that it was a source of very specific kind of risks. It's not something that any other risk in a way. First, it is far-reaching in breadth and magnitude. It could be huge. It's something that is foreseeable, but not easily predictable. And that's the problem, actually. You know it's going to happen, but you don't really know exactly following which pathways, when, how. So this is a bit of a challenge. It could be irreversible if we don't act quickly. And the positive impact you're going to make will show over a longer time. Clearly, you need to act to take some short-term measures, but the effects will show only in the longer term. And so there is this time inconsistency, which also makes it difficult for central banks, but also political actors to do something about that. And so clearly what we said is that climate-related risks are a source of financial risk, both for the financial system and also for financial institutions. And for that reason, it was part of the mandate. It was part of the financial stability mandate of central banks, and they had to do something about it. It was not nice to have, but a must have. If they were not taking that into account, they wouldn't discharge their mandate. We can move to the next slide, please. So after 1.5 years of research and work together, the NGFS produced its first comprehensive report, which is the outcome of the scoping exercise that we've been doing. And we always had this question that was, okay, so what's in there for us, for central banks and supervisors? What can we do? And in this report, we came up with 6 recommendations. 4 of them are addressed at us, central banks and supervisors, and 2 others are addressed at policymakers at large, so that they can help us. So the first 4 recommendations are pretty common sense when we mention them, but it was not that obvious 3 years ago. First, the idea is to say, if climate risk is a source of financial risk, then central banks and supervisors need to include that in their own risk analysis and supervisory practices. They have to take that on board. Second recommendation, they have to be consistent as well. If they say to their banks and insurance companies, look, guys, you need to be able to identify climate risk and do something about it, then you need to reflect that as well in your own investment policies. And typically what we said at the time is that we also need to include as much as possible sustainability factors in our non-monetary portfolio. We started by non-monetary portfolio first. Third recommendation is also very important. It's a key recommendation. It's the issue of data gaps. We found out that there were a number of gaps everywhere we look to be able for us to conduct the risk analysis, simply because you needed to put together financial data, non-financial data. You do not necessarily have the right level of granularity you need. So there is a gap to be filled, and we were calling actors to work together to fill that gap. Fourth recommendation is very, very important, in particular for emerging countries. It's this idea of building awareness and intellectual capacity and technical assistance. Clearly, some countries are ahead. They've done a lot of research, and others are still struggling a bit. So the idea is really for us to share best practices quickly so that everybody can leapfrog. And this is very important for us. Finally, 6 recommendations addressed at policymakers at large. First, of course, we need a consistent and coherent disclosure in order to have some comparable set of data. And finally, I can get back to that later during the Q&A. We need also proper taxonomy of economic activities. Taxonomy, what is that? It's a definition of what are the activities more specifically exposed to climate change and those who contribute to a low carbon transition. Can move to the next slide, please. So here, I'm not going to enter too much into the detail, but we can get back to that later. But this is just the various work streams and the responsibilities within the NGFS. So the chair, the various work streams there, and we don't need to spend too much time on that. We can move to next slide, please. So what do we want to do now? I mean, after having published this guide with some nice principles, I mean, the question is, okay, so what do you do in practice? How do we, make things concrete and operational for everyone? And so since April 2019, this is precisely what the NGFS has been trying to do, trying to develop some guides, some books with very practical examples, case studies, so that central banks from all over the world who wants to do something about it can just take it, read it, and implement. So we want to be very concrete and operational. So we've done so, for example, for sustainable and responsible investment, for central banks, portfolio management. We have also produced in May this year a guide for supervisors, how to integrate climate-related and environmental risks into prudential supervision. We provide guidances and examples. And also, last but not least, we also published in June a guide on climate scenario analysis, which is, of course, a key part of the work, because, of course, climate change is forward-looking. And so you need to develop your own scenarios in order to have your forward-looking risk analysis. So we tabled this proposal in June, and of course, we're going to update it again, but we're very happy to have feedback from stakeholders. Next slide, please.
For 3 minutes.
Well, there might be a bit of a bug, but not a problem. I wanted to highlight in the next slide. Oh, sorry.
Alain? We seem to have lost Mr. Dupree. Alain?
I'm back. I'm back.
I'm back. Okay, you're back. Okay, sorry. Modern technology.
Sorry. So what did you miss? Did I mention the practical guides? I think I did.
Yeah.
And just a few words looking ahead, what we want to do going forward. We want to do a number of things. We want to continue keeping track of the initiative best practices among the membership. We continue to work with a consortium of economic partners to update the scenarios. And this is a big chunk as well. We're starting to consider how to include climate-related risk considerations into monetary policy operational framework. It's complicated, of course. It's a bit sensitive politically, but we want to continue working on that. And lastly, we're going to try to work on data, metrics, and research as well, because we think on bridging data gaps, we certainly have something to say to also help and define the kind of metrics we want to have. All right, many thanks for that.
Is that the end of your presentation? Or
it is the end.
Oh, okay.
It is the end. The last slide is about bibliography and some links to our publications for those who want to know more.
Thank you very much, Mr. Dupree. Right on time. Now let's come to our next presenter, Najwa Muhairi, who is with Bank Al-Maghrib. Najwa, you have the floor. Thank you.
Thank you, Mohammed Khalif. It is my absolute pleasure to be taking part to this high-level panel to provide some insights into Bank Al-Maghrib's experience and approach on climate-related risk supervision and experience in supporting green finance, but also to share some of the challenges as well as possible solutions to further unlock green financing from the banking sector. If we can move to the third slide, please. Next one, please. So on the occasion of the COP22, there was actually, no, previous one. Thank you. So on the occasion of COP22, that was actually hosted in Marrakesh in 2016, sustainable finance has emerged as a pathway for Morocco to de-risk investments and enable financial flows needed for sustainable development. So with the coordination of Bank Al-Maghrib and demonstrating a successful collaboration between public, private sector and government bodies, the financial industry has actually developed two roadmaps to develop sustainable finance both in Morocco and Africa. So the national roadmap centers around 5 main areas of focus, and the most major one include actually the governance of environmental and social risks, green finance development, and capacity building in the field of sustainable finance. At the regional level, this roadmap involves actually a multi-stakeholder collaboration for the emergence of sustainable finance in Africa. If we can move to the next slide, please. Just to provide a quick overview of the initiatives taken by the banking institutions, following the national roadmap for online and the financial sector with sustainable development, which I may come back to into more details during discussions. To name but a few, these measures include actually the voluntary adoption of excluding policies by major banks, the adherence and commitment to international principles, but most importantly, green finance development and mobilization through some green bond issuance, but also the mobilization of international financing programs that support low carbon solutions and green projects. Moving to the next slide. From the financial inclusion side, the banking institutions have actually extended their financing solutions to cover SMEs and low-income households. Next, please. So this brings me to our strategic response to climate change impact as a central bank. We have actually joined the large consensus built among central banks that climate change poses significant challenges for financial stability and prudential supervision, and we have integrated green finance into our strategic planning for the 5 coming years. So our strategic plan on green finance, the objective of our strategic plan on green finance is actually threefold. First, to engage with national and regional stakeholders to enhance commitment and cooperation in green finance. Second, to contribute to international work. And finally, to understand, assess, and supervise climate-related risks in the banking sector. Next slide, please. So regarding the first objective related to coordination and dialogue with stakeholders and regulators, we have actually conducted several exchanges with the ministries of environment and finance to coordinate efforts at the national level to promote green finance, but also to turn NGFS recommendations for policymakers into actionable policies. Sustained dialogue is also actually ensured with financial regulators for capital markets and insurance companies on the challenges and opportunities of climate action and financial and environmental sustainability financing. At the regional level, Bank Al-Maghrib is actually ambitious to act as a catalyst for the development of green finance in Africa and is promoting the debate on this particular topic through the organization and participation into regional and international events that enable technical discussions on green finance. Moving to the next slide. So as far as contribution to international work is concerned, Bank Al-Maghrib is actually committed to support and enrich international work on green finance, and has actually took such a prominent and leadership role, being one of the first participants in the network for green in the financial system. As a member, we actually contribute to its work streams and ensure by doing so that NGFS takeaways and work priorities also take into consideration issues of particular importance to developing and African countries. At the same time, we have actually, Thank you. At the same time, we have actually encouraged many African central banks to join the network, and we have seen since then a growing interest among these central banks to join the network. We are also providing an active support to the work of AFI on inclusive green finance, of which we serve as a vice co-chair. Moving to the next slide, please. Sorry. We are also a member of the Sustainable Banking Network alongside the Moroccan Authority for Capital Markets, which is an initiative of the IFC, which focuses on advancing sustainable finance in emerging markets and tracks the progress in terms of strategic alignment, ESG integration, and sustainable finance implementation more broadly. So in 2019, the overall rating of Morocco has actually been upgraded thanks to the initiatives taken by the central bank to implement a supportive regulatory framework. And finally, on a different note, we have actually been involved in the drafting of the 23rd edition of the Financial Stability Review of Banque de France, with a publication on the challenges and prospects of green finance in Africa. And more recently, we have submitted an article proposal on COVID to the African Development Bank, in which we actually reflect on the COVID-19 crisis impacts on the greening of the financial sector. Moving to the next slide, please. This brings me to our ongoing projects on climate-related risks assessment and supervision. We have actually launched
another technical glitch, I guess.
Yeah, I think we lost her.
Okay, let's see. Give her 1 or 2 minutes. Hopefully she will reconnect.
Sorry, I'm experiencing some technical difficulties. Sorry about that.
Welcome back.
So, thank you. I was saying that regarding our ongoing climate-related risks assessment and supervision projects, we are aware of of the need to better understand climate-related risks in order to properly supervise these risks in the banking sector and ensure they are effectively managed by the banking institutions. So we have launched as a first step with the support of the World Bank a 2-year work program to evolve our approach to banking supervision, taking into consideration these emerging risks. So this program actually relies on 3 main components, including assessing the exposures of the banking institutions to climate-related financial risks, the implementation of supervisory guidance and monitoring practices, and finally to the capacity building actions to build the necessary expertise actually to implement the appropriate supervisory tools. We are also currently discussing with l'Agence Française de Développement the launch of a national study of transition risks. This countrywide study aims actually to identify and assess key transition risks that could affect Moroccan's economy's resilience, but also the financial system's soundness. So, and aims to implement the necessary policy actions to affront the systemic threat of climate change and environmental decline. And last but not least, we will issue before the end of this year a regulatory text, which is expected to introduce requirements for banks to manage climate-related and environmental financial risks and disclose information about their exposures to these risks. So this text was actually established through a broad consultation process that involved dialogue with international experts, including the African Development Bank's ones, while also taking into consideration banking institutions' view. Moving to the next slide, please. So just to provide a few more information on the soon to be issued regulatory text, I'm not going to go into details. These texts actually cover both climate related and environmental related risks and draws on international best practices observed among advanced central banks and the international standards developed by TCFD with regards to integrating climate related risks into governance, strategic planning, governance, and risk management framework, as well as developing risk metrics and indicators. Next slide, please. So regarding the challenges and looking ahead, Morocco, like many emerging and African countries, continues to face constraints, structural constraints that limit climate financing. So while there are positive steps in terms of sustainable and green finance frameworks implementation, far more ambitious plans and accelerated actions are actually needed on strategic alignment and national coordination to develop a green taxonomy of green assets and activities to give some sort of new impetus to green financing flows. Access to data finance and certain capacities need also to be scaled up at a much faster rate as we are facing limited national expertise when it comes to translating climate-related risks into related ones, and especially with regards assessing the risks and returns of adaptation projects which reveal our mitigation ones in the context of developing countries. Challenges also lie in further development of fiscal and regulatory policy actions, and especially coordinated regulatory and tax incentives that will play a key role in financial flows becoming commensurate with adaptation and mitigation ambition. So all these challenges are actually are even more urgent to address under the COVID-19 recovery plan. So as a central bank, we are actually striving for a greater coordination at the national level to address these challenges, harmonize practices across the banking sector, and mitigate climate change impacts in the banking sector. Thank you. This concludes my presentation.
Thank you, Ms. Muhairi. Very informative presentation. Now we come to our last, certainly not the least presenter, Dr. Tony, who will now do who is the Director of African Development Bank. Tony, you have the floor, please. Tony, are you on mute? Can anybody hear Tony? Alan, Tony, you are on mute. Okay, all right.
He's not on mute, but he actually has a problem with his microphone because we are hearing a beep. So I think he has technical issues.
Tony, we can't hear you. Can you guys hear Tony? Stefan, can you hear Tony?
No. No, I can't.
Okay, I can't either.
Is he on? Hold on a second. Yeah, he's not on mute. Huh?
No, he's not on
Maybe
mute,
he's
but
reconnecting. Maybe he's
Yeah,
reconnecting.
can you hear me now?
yeah, we can hear you. Yeah, you have static,
Okay,
but you're good.
I've just switched to my phone. There's going to be an echo, so I need to switch one off. Let me log off from this. Okay, can you hear me now?
Yeah, we can hear you, Tony, loud and clear.
Okay, thanks. So I'm using my phone. Yeah, like I said, this is a very important meeting, Mohammed, Stefan, and the team. Thanks for putting this up because it's quite important. The first slide, next, please, is basically just puts in numbers, as it were, to the issues of climate change on the African continent. When you look at the map of vulnerability, it basically looks like the map of Africa, and we're seeing so many things happening. Yes, we're going to talk about the risks, but importantly, I want to also talk about the opportunities for the banking sector. It's not so much the risk. Next slide, please. You know, when you look at this slide, this shows the weather-related losses worldwide between 1980 and 2016. You see the spikes, you know, coming up. Then these are uninsured losses. So when you look at the gap between the insured and the uninsured losses, it's expanding. That tells us something, that the insurance company, you know, or the insurance sector has a major role to play and is adversely affected by this. Next slide, please. Then when you look at what has happened, the losses, we've now tried to bring it down to the African region. And by the way, most times when we make these presentations or talk about this, everyone thinks of Africa as a country, you know, and so on. It's not. These are 54 African countries, some doing well, some highly, very highly vulnerable, you know, and we see the different sources, the extreme events happening, and the correspondent losses. For the developing countries alone in Africa, by 2000 and within that period, 2017, they lost about 1.8% of GDP. This is an annual thing, and this is really quite serious for poor African countries who experience economic losses of about 1.8% of their GDP. Next, please. Then the dilemma of it is that the financial sector has an important role to play in addressing climate change in Africa. The private sector, it is expected, would provide about 75% of the resources needed to address climate change. But then this private sector is on its own highly vulnerable, particularly the financial sector. So this slide basically just tells us, you know, schematics of what could happen with these climate hazards that we see. One, insurance costs will go up. Uninsurable risk will also increase because as the premium goes up, many people back off. And once disasters strike, you are not insured. I think you feel the impact more. Then we also see pension and several sovereign wealth funds. Their investments are negatively impacted because these guys also invest where other private sector players put their money. And when these extreme events come, for instance, I know that last year we had Hurricane Idai in Mozambique, hit Zimbabwe, hit Malawi. It destroyed infrastructure worth about $2 billion. Part of that infrastructure was built with sovereign wealth funds, some of it loans from banks. With that level of destruction, there's absolutely no way those companies are going to be able to, the government is going to be able to pay back. So there is a potential that we might be seeing loan defaults, and so on, where they got money from banks or they got money from sovereign wealth funds. And then the central banks, with all this happening, the insurance going down, the sovereign wealth funds not getting back its investments, central banks, banks, commercial banks, the regional development banks experiencing loan defaults, then this poses a major problem to us on the continent. Next, please. Next slide. Yeah, so then we are not only looking at that risk that is caused directly by climate change, the physical risks. We're also looking at the transition risk. We are being asked to transition to a low carbon development pathway. The financial institutions, yes, are going to play a major role in this transition, but this transition poses its own risks. The policies that are going to be put in place may not be very favorable to some of our banking institutions. The fact that we really don't understand what we are going to meet at the end of it. If we're pulling out of coal, pulling out of oil, going into renewables more like solar, what do we find there? What's going to be the level of uptake? What's the possibility that we're going to have stranded assets from the present investments that are taking place? And not only the present investments, we're also looking at the investments in renewable energy. We're seeing prices drop so fast. Banks gave out loans at certain interest rates. When the prices fall so fast, so much, will the people that borrow this money be able to immediately pay for this? We're also seeing divestments from fuel. Several organizations are saying we're no longer going to invest in fossil fuel. The banks, many banks are following that path. What happens to the investments that the banks put? Next slide. So, like my two colleagues have spoken, I'm not going to dwell too much on this. There are several global initiatives that have been put in to green the banking system. These are working. But next slide. Where we found issues was when we now decided to look at Africa's participation in most of these initiatives. The slide you're seeing, green are non-African countries, and then the orange are the African countries. You'll find that across all this, that African countries are not properly represented or have signed onto these global initiatives. My colleague mentioned about 5 African countries that have signed onto the NGFS. These are 5 middle-income countries. What happens to that band in the first slide that we put, the sub-Saharan Africa, removing South Africa, where climate change really is impactful, where the need to sign on to these initiatives, we don't find representatives there. Next slide. So we looked at it. What are the opportunities for the banks? When we speak so much about risks, vulnerability, negative impact, it scares away private investors. It scares away the banks because banks don't want to put their money in such risky businesses. But I know that climate change also has opportunities that the banking sector can capitalize on. For instance, the real estate assets at risk, projected by 2070 is going to be about 35 trillion. What can the banks do to hedge that risk? What can the banks do to take advantage of what is going to happen by 2070? Then we've seen, for instance, that the impact investors are the market for impact investors are increasing, but many banks still do not understand how climate change could provide an opportunity, and because of that, they are not really lending money to impact investors who really want to invest in that space. Then for the opportunities for Africa, like Stefan had mentioned, we have the NDCs, provides opportunity of about $3 trillion. It's the private sector that will do it, and the private sector will need to come to the banks to borrow that money. We have renewable energy investment potential by 2030, at about $384 billion. This is opportunity for Africa's banking sector. Next slide. This is what I just talked about in terms of potential impact investments. Market is huge because of Africa's population, but we need to get the policies right for the banking sector. Next, please. Then I won't dwell too much on this also because we've looked at, but what we did is we've looked at it that the supervisors are good, the central banks are good, but there are other players in the financial sector that need to be carried along. The government institutions, the central banks in most countries are not as independent as we think they are because they are part of the economy of that country. So they work together. If the ministries of finance are not doing right, I'm not sure that the central banks can do right and so on. So we need to bring the financial institutions together. We need to bring the government institutions together. They all have a role to play. Next slide. Next slide. I'm soon rounding up. Then we have the rating agencies. This is the one that is usually overlooked. The rating agencies have an important role to play because they can factor in climate change into credit worthiness assessments. This will help a lot. We are doing that with the stock exchanges. Then we have institutional investors that also need to play a part. They influence investing companies in decision making. Next slide. Here is an initiative that we have done at the African Development Bank called the Africa Financial Alliance on Climate Change. What this does is it brings everyone, all the key players in Africa's financial sector to align their investments towards supporting Africa's low carbon and climate resilient development, taking advantage of the opportunities and managing the risks that come with it. So what it involves, we have membership across from multilateral. We have central banks, I'll soon round up, this is my last slide. We have the commercial banks, we have the institutional investors. Everyone has a role to play. We have gone ahead to check what is the problem. Most of the banks have said they have very little knowledge. Most of these financial institutions, they have very little knowledge and awareness on climate change impact. How can you help us? So we've done quite a series of training across several institutions, central banks, insurance companies, and so on, and pension funds. The next is the need to see how we can help them mainstream climate change mitigation and adaptation, and produce financial instruments and technologies for them. Thirdly, we are enhancing risk disclosures, because when you get comfortable, you know what it is, then you can begin to announce your risks, and that's when you can go up to the CFD and other global initiatives. Until then, they are not very comfortable to step out and play at the global space that others are playing. And then we are also channeling investments for climate resilient development through these institutions. Very many of them have missed the opportunity of being recipients, channels through which large resources come in. There is a lot that is being done. Many companies are divesting from coal. As they're divesting from coal, they want to put that money where they know that they would encourage impact investment, where those companies themselves have proper climate change policies, procedures, and strategies. So we believe that as time goes on, that we are going to see more and more of these initiatives working. We're working with Nigeria, for instance, on what we call the Central Bank Sustainability Banking Awards. It's a way of encouraging countries, financial institutions to align their investments with sustainability, and they get prizes for it at the end of the year. We're seeing an increase in the number of financial institutions that are taking part in this initiative, showing the appetite there is for such an investment. So I think I end it here, and thank you so very much. I'm open to questions.
Thank you very much, Tony. I will certainly will be now asking all panelists to send their questions through the chat. But while we're waiting for questions from the floor or from the participants, I would like to ask a couple of questions to the first question to all three questions, to all three panelists. And we all know that central banks do not or cannot set up environmental policies. It's in fact the job of the government to do that. So, Tony, what are some of the tangible policies that the African governments, and you have mentioned that central banks have limited, limited authority to, they are not completely independent. You mentioned that. What are the tangible policies that some of the African governments are actually implementing and or formulating to, let's say, to reduce, mitigate risks inherent or associated with climate change? So that's a question, because it's more to Tony, because the African Development Bank covers the whole 54 African countries. The second question that I would like to pose, and it's to all three members, is what are the best ways that climate change can be managed or the risks can be reduced in general? What do you expect us to convey to banks, companies, individuals, and governments? What are the best ways that a climate change can be managed and or mitigated? So let me first start with Tony on the question of what the African countries are doing in terms of policy.
Yeah, thanks so very much, Mohammed. Yes, countries have policies on environment, social safeguards, and climate change, green growth. We have countries, we have all this. We have long-term emissions reduction strategies, we have adaptation policies, and so on. All the central banks need to do is to see how can they adapt, domesticate this into their own policies. For instance, just as we have here, that the bank will not invest in projects that do not meet certain requirements. Every institution can do it. We have corporate organizations that have set up environmental and social management systems in their institutions with codes of conduct, ethics that say we will not invest in projects, programs that destroy the environment, that increase the gender disparity, and so on. So these are some of the things that are happening. So what the central banks can do, like in Nigeria that we've gone very far with them, they have a department for sustainability banking. It is that department that deals with issues of what climate change policies can be done. I give you an instance. If you want to bring in solar panels, by central bank's policies, the interest you will pay on those renewable energy technologies will be less than what you would pay if you brought in higher polluting technologies. So that encourages people to take loans at lower interest rates encourages the spread of renewable energy technologies. In the UK, I know that it was mandatory, I don't know if it's still the case, that every board, must have, in the financial institutions, must have a climate change constituency, which means there is somebody on that board that represents the climate change constituency, that ensures that everything that is going to be done has something to do with climate change. You're either not going to be polluting or you're going to build resilience into it. So, but the greatest challenge that we've had, like I've said, amongst this has been the limited awareness of what they themselves can do and how they can promote these initiatives. Every institution has a right to develop its own environmental and social management system. And that, when done at the central banks, can then be passed on to the commercial banks. Thanks, I hope I've answered the question.
Thank you very much. The second question was, what are the best ways that climate change can be managed? And I would like to give that the first question to Morgan, Mr. Dupree. We'll appreciate your response in this one, that then Network can chip in as well.
Mohammed, could you please repeat the question?
The question is, what are the best ways that climate change can be managed and or climate change risk can be managed and or mitigated?
Okay, right. Well, it is of course difficult, and it is also related to the first question you asked to Tony, because central banks and supervisors alone don't have the answer and don't have the solution. What is clear is that climate change will have an impact over time, and it's still pretty much, I mean, the precise pathway is still pretty much uncertain and varies very much depending on actions which are taken now. So in an ideal world, you should have the government defining a clear carbon pricing pathways for 15 to 20 years, defining a very clear time frame from phasing out of some technologies or some energies, and you should have a central bank and a supervisor able to carry out some stress testing analysis using some scenarios and asking their banks and insurance companies to play following those scenarios. Everything is very much ideal, as we can see. So, I mean, probably the first step to do is trying to engage with your banking community locally. Ask them if they do something about it, if they have a number of governance structures in place. And progressively, you can develop also other things like a survey. That's just something we did at the Banque de France at the beginning as well. And then you move up to something that is more quantitative. And finally, you can move to a more fully fledged scenario analysis. But all in all, it's difficult, and I will finish with that. What is difficult as well is that we're not in a world where everything is unknown, everything is stabilized, we have the proper data, we have the right models. We don't. So we have to do in a very suboptimal environment. But on the other hand, if we do nothing, then we'll be in real troubles in a few years from now. So I would say it's a bit of a trade-off between trying to do the best thing and trying to do what you have to do quickly. And this is a path for central banks and supervisors to find it and try to smuggle in.
Thank you very much, Mr. Dupree. Madame Najwa?
Yes, I agree with Morgan. It is quite difficult at this stage to determine the right approach to address climate change impacts from the central banks. They can do it alone. So, but still, they have a key role to play in advancing transition to a low carbon economy, but also to further unlocking green financing from the banking sector. First, by implementing a supportive regulatory framework and enabling environment, as regulatory measures ensure raising awareness about the significance of climate-related risks in the banking sector by underlying the need of climate action among these institutions, while also helping them to assess their exposures to climate-related risks. So a number of prudential tools where actually climate change can be integrated are available to improve the transparency about climate-related risks and ensure they are effectively managed by the banking institutions. And second, the central banks have also a key role to play in coordinating action at the national level with the national authorities by ensuring that green finance is actually driven by all stakeholders under a common, coordinated, and progressive approach. Such approaches, central bank-driven approaches, provide a broad framework and principles to manage environmental and climate change-related risks. Thank you.
Thank you, Najwa. We have so many questions from the participants or the attendees of the webinar. So let me start with the first one. Kerry Cohen writes, and the following: would you think that defining clauses or conditions in infrastructure contracts will help address the issue of climate change? That's a question to very briefly to all panel members. Let me give that.
Can you come again? Defining what?
Defining, let's say, defining conditions or clauses in infrastructure contracts for project finance, for example. In project finance, when you have the contract or loans for the banks, or is it very important to incorporate clauses, conditions that clearly define the infrastructure contract to address the issue of climate change? That's the question, Tony. So you have the floor, and let's be very brief.
Yeah, thanks. I think this is something the bank does. The bank screens all its projects, infrastructure projects, for climate risks. And then where we find that that infrastructure project is vulnerable or risky, we build in resilience into it. For instance, the East-West Road, sorry, the Lagos Dhaka highway that we're doing, it wasn't there initially, but at some point after it was designed, we now have to put flood protection stretches on those parts of the road. We also screen our investments for climate risk, for greenhouse gas emissions, where we find that we have better alternatives that would reduce greenhouse gas emissions. We take that. So what we're trying to do with the AFAC, Africa Financial Alliance, like the TCFD, is for investors to disclose what potential risks there are. So for us, we build in that risk, we build in that resilience into that infrastructure contract from the beginning. Thanks.
Thank you. Next, with the same question, how does that help? Does it help? And if it's yes, how?
Surely it does, but it's not the only necessary condition. I think this also falls under the taxonomy, which defines in more details the activities that are eligible for climate financing and how to improve climate change mitigation and adaptation. Since we have no taxonomy at this stage, I think that banks try to have this effort nationally, but they need the national authorities' support to further consider this kind of particular aspects while taking their financing decisions.
Thank you very much. The next question goes to Mr. Dupree, and it's from Mr. Ibrahim, and it says, how do banks monitor the climate impact of the firms or the private sector players seeking their funding? how do, let's say, commercial banks monitor the impact of their funding to the real sector, to the private entities? That's the question. Mr. Dupree, you have the floor.
Thank you. So what I can talk about is about what is going on in France, for example. So in France, we have a specific law. It's a law to energy transition law. And in that law, there is a provision that makes sure that banks and insurance companies publish each year in their annual report their exposures to climate change. The problem is this law gives only principles, but doesn't give very clear details as to how to do it. And so in practice, each bank and each insurance company in France should be able to measure and publish each year its exposures. Having said that, usually it's not necessarily granular enough. It's not necessarily standardized enough for us to do the risk analysis. And so what we have done beyond this is some supervisory exercises. So in short, 2 years ago and last year as well, the ACPR, the French Supervisory Authority, has conducted an ad hoc survey in a bilateral basis with each bank to measure more precisely, taking a look at a balance sheet, the exposures of each bank to climate risks at large. And here I can give you an interesting figures. The scope of the exercise covered all exposures of French banks wherever they are in the world. So it means that if BNP Paribas is providing credit in Thailand, that it would be included in there. And it's shown that around a third of the balance sheet of the French banking sector was exposed to some form of climate risks, which is extremely important. And so clearly doing that exercise, even though it's not perfect, it's sometimes a bit static and not forward-looking, is already a very, very good first step. And it also helps to engage dialogue with banks, because sometimes, the management of the bank is not even aware of that. So only asking questions, asking them to look at their own internal processes does help a lot, I think.
Thank you, Mr. Dupree. I think we have too many questions. Generally, moderator provides an opportunity for other panel members to respond to the same question. But given the number of questions, that it's a very interesting discussion. So we're getting many questions. So if you other members, if you want to let's say a few words about how commercial banks can monitor the impact of their funding to private sector. Najwa, do you have anything to add to what Mr. Dupree said?
Yeah, I think, okay, sorry, go ahead, Najwa.
Okay, thank you. At this stage, Moroccan banks haven't performed any analysis of their exposures, as the internal expertise are currently lacking. But we are. This is in the focus of our regulatory text. So we will try in the near future to support banking sector to monitor their exposures by conducting some scenario analysis exercises to capture the flow of risks that may not be obvious immediately. So this could be a good starting point, and we are trying to leverage on the experienced countries and central banks on this matter to leverage their tools at our national policy and regulatory making level.
Thank you, Najwa. Tony?
Yeah, I think it's like what the African Development Bank does. I'm sure the commercial banks could also get to that point. Some are actually doing it. It's not as if they are not. They monitor, their investments. Like I've said, Nigeria has this Central Bank of Nigeria Sustainability Banking Awards, where you have to tell us how your projects have contributed to building resilience, reducing emissions, managing environmental and social impacts. And that means they are able to put in project officers that keep track of that. It's a good example. It's something that can be replicated across several other financial institutions.
Thank you very much. Just by the way, I'm head of financial intermediation. We provide large loans to commercial banks, and I think we actually stipulate in our loan conditions that those same conditions are actually passed to the project that commercial banks finance. So they are, in fact, they are supposed to report, and we provide a template in which they are supposed to provide those monitoring and evaluation and continuous report. Now, the next question. It says capacity building for financial sector should be on a top action, because very few of us, and I think it's somebody from a commercial bank who's writing this, knows exactly how these risks and opportunity translate from an environmental to financial. So the question is, are there any key capacity building sessions scheduled for next year, the i.e. 2021, that we could attend? So the question is for the African banks. Tony, are we stipulating to conduct seminars that will enhance the skill set and the know-how and the capacity building of those commercial banks about climate change and how they should assess and monitor? Is this something that we can do as a development financial institution? So the question is to Tony, and also to Najwa, who also represents one of the African central banks. Tony, you have the floor.
Yeah, thank you very much. We've done several awareness sessions. That was just awareness raising. We've already concluded a program with Toronto Center that will do very in-depth training, 1 week long training per region for Africa, first to central banks and supervisors on this matter. Then we'll go into the commercial banks and the other banks, and so on. This is real hands-on training. What sort of data do you have? How can you acquire the data? What can you do with it? How can you do that basic modeling or interpret modeling results to give you an idea of what might happen in the next couple of years in that region? So this is something that we actually should have done in this quarter, but we had a setback with the COVID-19 and trying to get things together to understand, let the central banks and all the supervisors know it to be online. We're working out a way to make sure that it's very effective. So first quarter of next year, we're going to roll that out. We've also received a request from the Africa Association of Development Finance Institutions. We are also going to do that training for them first quarter of next year, hands-on training on climate change and the risks, and how to factor that into investment decisions.
Good. I think we should discuss also one for commercial banks, African commercial banks, in
yes, definitely
maybe second quarter of 2021. Next one. Any technical assistance capacity building for Moroccan banks from the central bank?
It is something that we are much focused on in the Green Finance Unit. We organize several awareness raising sessions with the commercial banks, in which we actually share and disseminate the NGFS main knowledge products and publications, and especially the ones that provide strong scientific evidence on how increased temperature and climate events could create financial physical risks for financial institutions. And the main methodologies of assessment that could be applicable for their particular case. So we're trying to raise awareness and to share the international developments which are actually used to advance the dialogue with the Moroccan banking institutions to accelerate their consideration of climate-related risks before the implementation of an appropriate supervisory framework.
Thank you. The next question is to Mr. Dupree. One of our participants writes, I wonder how these initiatives are cascaded down to other financial sectors, financial sector providers such as the insurance companies. This is because for banks and their clients to mitigate the effect of climate change, they need some form of insurance for risk sharing. So, Mr. Dupree, is the question very clear?
I would try to manage.
Repeat if you want to. It's very simple.
No, it's okay.
How can we, these climate change initiatives, that these mitigants and risk and other can be cascaded down to other financial sectors? Because those financial sector providers also provide risk sharing with banks.
Yeah, sure. Well, clearly, banks and insurance companies have different risk profiles. For banks, for example, they are affected in their lending activities to a large extent, and for the insurance companies, they're affected both in their investing capacities and also in their policy issuance capacity, liabilities and asset side, on both sides. And of course, the nature of the risks are different. Typically, physical risks is very much relevant for insurance companies because they're supposed to provide coverage, even though most of the time it is very, very far from covering everything that is being at risk. But still, they are so they have already this experience of taking a look at collecting big data and trying to look through over a long period of time how climate risk and physical risk materializes, but they're also affected in their investment capacities because they do invest a premium and on financial markets and provide funding as well. So at the end of the day, they are affected altogether, even though it's not necessarily the same kind of risks. But typically, for example, this question of pathways to the transition to a low carbon economy is something that affects them both, banks and insurance. And sometimes the time horizon is a little bit longer as well on the insurance side than on the banking side. But still, it's very relevant for both. And there is also an international network of insurance supervisors that's called the Sustainable Insurance Forum. And they also do a number of work. They work with us as well. And maybe last point, if you allow me on technical assistance and capacity building, we have identified that as a really key point in the work program of the NGFS. We just need to find out a way to package that and some partners we could work with. But we understand there is a real pressing need here.
Thank you, Mr. Dupree. The next question is.
Can I take on that request?
Yeah, Tony, you can add. I know I'm not being fair because I should give every panel at the same time, but go ahead and because we have got so many questions. It's very interesting.
Yeah, I'm just trying to say that the African Development Bank is ready to partner with NGFS because it's something we've started doing already on this training. And if they also have the intention to develop this training, I think the way we synchronize and work together makes that much better and bigger if we can partner together. So we're available to join hands with you and deliver these training sessions.
Excellent. My next question is for Najwa because she's a central banker. and it says how central banks will be technically assisted to understand and prepare for their supervision, the regulatory framework that they are going to they're going to roll down. So how would central banks, the question is how central banks will be technically assisted to understand and prepare their regulatory supervision text that they plan to roll out. Sorry.
Actually, given the complexity of financial modeling when it comes to translating climate-related or environmental-related risks into finance risks, one way of building expertise among central banks is actually, by fostering collaboration with the international community and international institutions who have already been involved in such in implementing such a supervisory framework or conducting such deep dive analysis of climate-related risks. Especially through the implementation of technical assistance, lending or knowledge products that would improve the market efficiency, but also attract more participation from the banking sector in green financing. This will also help the international organizations to deliver on their existing commitments to actually increase positive impacts in countries to address climate change, and especially in central banks addressing financial risks coming from climate change.
Thank you. My next question is a very long one, in fact. So how realistic, and this is to first to Tony and then to other panel members, how realistic is it to try and deal with climate change risk for African countries who depend on agriculture products and use and implement from machinery that have carbon emissions? It goes on to say, machineries, okay, what is the timeline for dealing with these climate change risks and address the climate change problem in general? So number one, the African countries depend on machineries, particularly in agriculture, that now emit carbon emissions. So what are the timelines and how can they be supported? So Tony, that is the question to you, given that you are the guru of climate change for the whole continent. And then I'll give that same question also to Mr. Dupree. Tony?
Yeah, thank you so very much. Let me first correct an impression. There's no rule anywhere that says Africa cannot emit any emissions whatsoever. So when you look at the amount of emissions a tractor would make, for instance, in it's driving a combined harvester or something, it's so insignificant. There's absolutely nothing that says Africa should not in any way. There is an emission that comes with development basic and so on. So that's not basically the emissions that we're worried about. What we're looking at is how do we build resilience into Africa's agriculture, which is basically what you've asked. And so we have solar technologies for pumping water, solar irrigation systems, where those apply. That's really working very well. We are providing heat tolerant seedlings to places because the temperature is rising in most other regions in Africa. So we, as a bank, through our technology for Africa's agricultural transformation, we are providing heat-tolerant crops, and we're also providing drought-resistant crop varieties. When you combine this, we've already reached about 5 million farmers thus far, and we will continue to do this to address those challenges that we have with climate change. As technology improves, maybe we'll be using electric cars, electric tractors, electric combined harvesters. We're seeing this happen, but there is a transition that takes us to that way. And what the climate change agreement, the Paris Agreement says, is that countries should transition to carbon neutrality by the middle of the century, which is 2050. But poor developing countries, including the LDCs, 72% of which are in Africa, can transition towards the second part of the century. That second part could be 2075, could be 2090, and we're working to make sure that this happens even earlier than that, once we can have the right sort of global support, the right kind of resources that African countries need. Thank you.
Thank you very much. I think we, in fact, have come to, it's exactly, I think, we had 1 hour and a half, and I think we come to the session, unfortunately, and our other panel member is Mr. Dupree has to go to another quick meeting, and I think we have a couple of questions, but I think we need to conclude. So I would like to thank our panel members for their contribution, insightful and expertise that they have provided with respect to our webinar, which is banking system and risks on climate change. We have, during their presentations, I think members have talked about what are the opportunities there. Climate change have challenges, but also we were told there are a lot of opportunities. We've been given the risks and also mitigants. We have been also given the different role of the ecosystem actors within the climate change. I think this is a very important topic, and that's why we have to, I think, take it very seriously. And I think we can have a continuous discussion to basically raise awareness, scale up awareness, ramp up awareness, particularly to African commercial banks. And I think this is an area we look forward to collaborating actively with Tony and also with central banks. Colleagues, Tony, thank you very much. Netwa, thank you very much for your contribution. I think Morgan has gone. He has to go to a different meeting. And of course, Stefano Vatambe for his opening remarks. I would also like to thank our colleagues who came up with the idea, Ismail, and the support we have received from Abdul Qadir and Alan Stefan, and all those participants who have asked very intelligent questions. I thank all of you very much, and we look forward to doing another webinar in the near future. Thank you very much. God bless. Thanks.
Thank you very much, colleagues.
Thank you, Mohammed.
Thanks, Mohammed. We're grateful. Thanks.
Thank you. Bye-bye.
Thank you.